But that's going to take time and a lot of capital investment.
Is it possible, though, I mean, this is not new news, right, Seth? I mean, we know ever since that deal was put together, the nuclear deal with Iran, that they were going to come back, the sanctions would be lifted and they'd come back in the oil markets. Isn't that possibly priced in already into this plunge in oil prices?
Well, I think that, yes, the deal's been in the process for a long time, except that a lot of people, these endless flurries, little rallies, or even big rallies that we had over the last year, what was really driving that was this supposition that by the time Iran comes back, we would have seen an impact of these low prices on non-OPEC supply. Shale started coming off a bit, but everyone was assuming that Russia and/or the North Sea or somewhere, some of these mature basins would have seen dramatic declines because of these low oil prices. Instead, we closed the year with Russia at record production, North Sea looking great, everywhere looking very healthy. So yes, the return of Iran has been a long time coming, but people thought that we would have cleared some room for that by now, and far from clearing room, we're really congested.
No, everyone's, as you say, they're all on full speed at this point. Seth, thank you so much. Appreciate you joining us. Seth Kleiman, the European head of energy research at Citigroup. Let's stay on energy for a moment more. Our next guest says all of this volatility is going to create buying opportunities for those who have a lot of risk in them and also who are also patient. But he says first you got to think small. So joining us now from Dallas, Texas is Eric Marshall. He's a co-manager of the Hodges Small Cap Fund, a Morningstar 4-star rated fund with $1.6 billion of assets under management. And you were just listening to our prior guest. Eric, I want to get your take first on what he was saying about more bad news for oil.
Well, we would agree that this is really a supply-driven problem, and we don't know exactly where oil is going to stabilize in the near term. You have China, OPEC production, and really what the dollar does relative to other currencies, all playing a big part in where oil goes in the near term. So at the Hodges funds, we're not trying to predict what oil prices are going to do in the near term. We know low prices will cure low prices eventually, but instead, we're really spending our time really focusing on what's going on in the underlying companies that we're investing in, and we think you can find opportunities in some of these beaten down oil stocks, as well as companies that are beneficiaries of lower oil prices.
Okay, so we'll get to some of the names you point out, but what areas do you think are going to recover first?
I think some of the really low-cost producers in the Permian that have under-leveraged balance sheets that are going to be able to take advantage of distressed asset sales, as well as some of the companies that aren't so much tied to what the near-term price of oil does, but just benefit from the stability in the market.
Okay, so you have a few names here, all of which, all these stocks, of course, have gone down, 40, 50% so far. RSP Permian, as you just mentioned, some opportunities there in that basin. Enlink, Midstream, and Aegean Marine Petroleum. So is there a common theme between these three?
No, there's really unique characteristics. In the case of RSP Permian, they are really a low-cost producer in the Midland Basin. What we like about them, they have a pristine balance sheet, and they have the staying power to make it through this downturn and come out the other side in probably a stronger competitive position. In the case of Enlink, this is one that's been thrown out with the bathwater in the MLP space. But when you look at their business, not all MLPs are created equally, and we like the general partner here because about 95% of their business is fixed rate, so they're not sensitive to the commodity price. About 80% of their production have fixed minimum volumes, which provide them very stable cash flow, ability to support an 8% dividend. They have an investment-grade credit rating, and most of their counterparty risk is with Devon. So we think that offers a great risk-reward, and you get paid a nice dividend while you wait. And then also Agena Marine, they are a distributor of marine fuel. And this company has gotten beaten up with everything having to do with oil tankers and transportation.
Right.
And they are essentially a floating gas station for the marine industry. And we like that stock. We think it's been oversold here and represents a very attractive risk reward relative to the underlying value of their assets.
Okay. All right, Eric, thank you so much. At least some ideas here if you're looking to take some big risks and also looking to buy some stocks on the cheap. All right, Eric Marshall, the co-manager of the Hodges Small Cap Fund. Still ahead on Bloomberg Markets, Donald Trump reacting to Ted Cruz's failure to disclose